Our friends over at 8cap are hosting another trading competition for A1 trading fans. If you're interested in testing your skills against other traders in the community, here's how you can join. Head on over to contest.8cap.com, you can find the link down below, and select the A1 Trading Demo Competition. Registration is open now and ends on August 19th. The competition will also start on August 19th and ends on September 2nd. You have the chance to win prizes for first, second, and third place finishes. All trading will be done on demo accounts, so there's no risk involved in the competition. Sign up now for free and good luck.
All right, guys. Good morning, good afternoon, wherever you are in the world. Thanks for being back with me for another live stream. Hope everyone is doing well. Another day, another high volatile market. That is for certain. Not sure if you guys saw this, but last night for me, depending on where you are in the world, if you're in Asia, it was morning time. If it was, UK, middle of the night. Last night for me, the Japanese stock market jumped up 6% on the day. And this is looking a lot better, but I don't necessarily think we're out of the woods yet. So let me give you my context here. So this is the Nikkei 225, which is the Japanese stock market, which, by the way, is a ginormous stock market in the world. All the attention in the world goes to the US stock market because it's the best performing, it's the largest, so on and so forth. But the Japanese stock market is also massive. And guys, if you were a Japanese investor or a Japanese stock market investor, you saw some really crazy volatility. 27.5% drop on the Nikkei 225 from peak to trough. That is, I think, the worst drawdown in such a fast period of time for the Nikkei in decades. I mean, that is an insane. That actually might have topped out 2020. Let's see. No, 2020 might have peaked to trough just a little bit more. But one of the fastest drops that we have seen in decades. Very ridiculously speedy drop, 27%. But with fast drops, oftentimes comes fast rips as well. Denise says, I love you. I love you too, Denise. Good morning, good afternoon. Hope everybody's doing well. So that alert woke me up. Which alert? Oh, also I got to do my intro music. Hold on, intro music coming in. So Nikkei's up 6%. Stocks are celebrating, or at least I wouldn't even say celebrating. They're just bouncing back. The volatility is so high that it's weird, guys. 1.5% day on the S&P, 1.9% day, 1.1 on the Dow, 2% on the Russell, just a casual 6 freaking percent on the Japanese stock market on the day to the upside. By the way, guys, that's like a yearly gain for a lot of stock markets in a day. Crazy. So let's think about this. Is the bottom in? Is the market going to rip from here? And also, let me just preface what I just said with these numbers. They sound very high, and they are very high if you're looking at the last, year or two. But in the last week or two, with volatility being so aggressively high, the VIX topping out at, I think, around 65. Is that right? Yeah, we had a VIX of 65. So when you have a VIX of 65, these numbers are actually, dare I say, in the short run, kind of normal days. I mean, so when I say, we're not out of the woods, what I mean by that is volatility is very, very high. At any moment, swing back the other direction, we could shoot through. But when volatility is high, we go from small-bodied daily candles to big ones. And big ones can be, big market moves can go both directions, and they can be very quick. So here's the thing. I do think that there is a possibility that we put in a low for the NASDAQ, but I want it to go lower. I don't think it will go lower, but I want it to. I made this whole grand plan the last few days about what I'm going to do if we continue to see this trajectory pick up steam to the downside. But I drew this level here, and what I've got here is drawn on the NASDAQ daily chart, a Fibonacci retracement from the swing high at 20,795 down to the previous swing low when we dropped that 6% in a day on the NASDAQ. And what we're left with is this level of resistance, this dotted line, which I've got as a target in the short run, 18,600 is the 38.2% retracement, as well as a key level of resistance. Now, let me be clear, I am still bullish and I have long positions all over the place. But as we approach that level, and I do think we probably will test that level, if we test that level, bears are going to have their attempt, I think, at that level. Now, I'm not saying I think bears are going to just wipe the floor and we're going to go much, much lower, but we certainly could. The environment for high volatility right now would tell you that we could go back still and test these lows, and we could get there pretty quick. This market is incredibly, incredibly volatile. But in my personal view, the risk to reward is better to the upside. So I've been going long on stuff, but I've also mentioned, and I did a whole plan on this, I marked out VOO and levels at which I would be looking to actually step in and deposit more money into my account. Now, I personally have, everybody has their own personal finance, situation, plan, etc. Maybe you're fully invested. Maybe you're not. For me, I am not fully invested. Not fully invested. What that means is that, my wife and I, we earn our money, and, some people choose to buy every single month, no matter what the stock market is doing. But for me and my wife, and I manage most of our, investments, as you might imagine. She has inputs and she has, thoughts on stuff, but she kind of yields that to me and I yield other things to her. So in my personal finance situation, we are not fully invested. And if we see a broader market sell-off, I've made the point that I would think that that's best case scenario. And in fact, for me, not for everybody, I'm saying, other people might not be wanting the stock market to drop. Other people might, be wanting it to just please rip higher. It's going to hurt if it goes lower. And I don't like that situation. I've been there before where I have, a lot of massive amounts of, my personal funds are all invested and I don't want the market to drop and it hurts. But here's the thing. For me, these are the times where I am glad that I'm not fully invested. And at these levels that I've drawn on the screen, and I'm going to leave these levels here unless we, make a drastic recovery and I need to change them. Unless we take out the all-time highs, at these levels, I will be adding to my account. So personally, I welcome the idea of a lower stock market. If it happens, I can get better prices, especially on stocks that I like, or, longer term names. You might call this, isn't that just passive investing? But the answer is no, because passive investing is just buying regular intervals every single month. And I get that, is a crowd favorite thing to do. And you'll also hear a lot of people say, Nick, passive investing is just the best. It's better to just dollar cost average. Look at this thing. It's better to just do this. But there are also times we're living in an environment where this is what everyone knows, and this is everyone's, go-to analysis of the stock market. They say this thing, oh, look at that. I got filled on my Tesla. That's great. I got to write that up in the group, by the way. But then you look at other times, and let's say you're going and you're looking at SPY, and let's go back to, can I go back to 2008? Yeah, I can. Look at this chart. If you had dollar cost averaged in this time, this would have been good, right? That's an environment where I'd be buying. I'd be adding to the account, building positions for the long run. But then personally, I would have stopped buying once we started, breaking to the upside. I probably would have been fully invested, on the way down. And this is hindsight 2020, I know. So I know people are kind of rolling their eyes. Of course, you would have bought and then, but I probably would have been buying early and I would have been buying often. And then when the market actually started to recover, I probably would have slowed buying, which would have been the right thing to do because then your dollar cost average is way down here. But then when we get this big run up, I'm not chasing or adding. But then when the market dropped again, I could have started adding more. And that would have ultimately led to an incredible life-changing amount of, gains. But my point with sharing that kind of concept is that some people choose to buy every single month, no matter what. And there's not a right way or wrong way to invest or trade per se. As long as you're making money in the long run, who cares? But here's my thought on it. I prefer to build positions on the stock market when they actually are, when I feel prices are good. When I feel prices are too expensive, I don't like to deposit. I don't like to, buy hard. I like to really stay on the sidelines when the market I feel is expensive. And I've started to buy. I've started to build positions, and I welcome lower prices, even though it might hurt in the short run and your P&L might look ugly. This is my personal approach. I'm sharing my thoughts on the market as always. Let me know what your thoughts are. And let's take a look at this NASDAQ. Again, coming back to this concept, NAS 100 very well may. If you're short term with it, if you're a bear, this is the level that I'm watching. And I'm not bearish. I'm just saying that I think bears are probably watching close, this 18,600 level. I bought a couple things here. I'm buying stocks, guys. I have not bought stocks, individual names, in a long time. It's actually been years since I've bought individual stocks. I bought Google yesterday. This morning, I think I bought CrowdStrike. Yep, got CrowdStrike. And I just bought some Tesla. So I'm buying this market, and these are longer term plays. When it comes to stocks, I don't really trade stocks, but I'll hold some in the account. These are small positions on the account, but I am adding officially to some stock names that I like. I've got some trades on S&P 500. I'm long on this one. I'm long SMH. Here's SMH. We'll see how this plays out, but starting out okay. And I'm long the Russell IWM. So these are some of my current positions. Which one is more important, bond prices or yields? Bond prices and yields are just inverse reflections of each other. If you're, looking at bond prices, maybe you're looking at like TLT, right? This is a bond ETF, which just holds a bunch of bonds for you. But if you want to look at yields on bonds, you could go take a look at the 2-year yield, which has dropped off, recently really hard. But bonds actually going up right now, or bond yields going up right now, is a positive thing, just like the dollar yen going up is a positive thing for global market sentiment. Let's talk about the yen for a moment. Okay, so the yen absolutely jumping to the upside. I actually think that in this case, I find this easier to look at. The Japanese yen against the US dollar rather than USD JPY, because this kind of paints the picture. The yen has been falling for months and years even. It has been a trade for hedge fund managers for a long time to short the yen, borrow yen, and go buy other things. Okay. So we can actually see that in the Commitment of Traders report. And I've been tracking this and discussing this a lot. The recent panic that we saw in the markets was right here. This was a big component of it. The number of short contracts traded in the last weekly COT filing showed that institutional money heavily covered shorts on the Japanese yen. So again, we're not speculating what smart money is doing. We're not trying to guess what smart money is doing based on a fancy technical candlestick pattern. We're not doing any of that. We are straight up looking at what smart money filed in the COT report. Okay. A lot of people like to get fancy on social media. You're going to hear people say trade like the banks or smart money this, smart money that, all this fancy, names. I'm not saying that it doesn't work. For me, marketing names are fun, but let's just look at straight up actually what smart money is doing through the Commitment of Traders report. So the Commitment of Traders report shows us that in the latest weekly filing, the Japanese yen overall saw a lot of buying, but how they bought the yen is very, very important to note. Now, you can do two types of buying in the futures market. It's all buying, but there's a distinct difference. You can either change in long contracts week to week, means you can buy long contracts. You can go long contracts of the Japanese yen. Or if you had a big short position on the Japanese yen and you close a short, how do you close a short position? You buy back your short. So that's buying. So this is buying and this is buying on the Japanese yen. But notice the difference here. It's not buying. This number is very small. This number is huge. Buying to cover is different than just buying to speculate going long on the yen. We saw both, but the drastic difference is that there was a massive short covering on the Japanese yen in the last filing. Now, I personally think that there's a chance that that might have been it, that you might have just seen a surge in the yen. And now that that margin call potentially is over, maybe it's not, maybe the yen's going much higher and, this will age terribly. But I think there's a chance, pretty good chance, especially with the VIX falling back down so hard, that might have been just a panic scare. And now that we've seen some deleveraging, maybe the market is set to bounce back. If I am dead wrong about that, again, I've laid out my plan. If I am dead wrong about that and that the carry trade is really, truly going to get much uglier and unwind a lot more hard than it has, then stocks would go much lower. And in that case, I've mentioned that I really like the longer term buying opportunities that could present. So I am long currently because I think the bottom might be in. But if I am dead wrong, and a week from now you hear me saying, oh my gosh, everything I thought was going to happen did not work out, it's actually the best case scenario for many of us. Not all of us, but for many of us, lower prices are opportunities in the longer run. And lower prices, by the way, if you get a yen carry trade unwind that truly becomes much more violent than we saw in the beginning of this week, then guess what? Everything's going to drop, including gold, silver, oil prices, the Nikkei, the Japanese stock market, the US stock market, stock markets across the world. And that will be painful in the short run for people who are bullish or long, like myself. In the short run, that would cause me to lose money. But in the long run, it would likely, in my opinion, create wonderful long-term buying opportunities. So I am really in a situation where I don't really care what the market does. If it goes up, I'll make money. If it goes down, I'll lose money, but probably make more money in the long run. Does that make sense? If you're on the same page, if that makes sense to you, do me a big favor. Thumbs up the stream. Thanks for being here. We've got 458 people watching between YouTube, Twitter, and anywhere else that we're live. We're live on, we're live on 4 different places. Trader Nick YouTube, A1 YouTube, A1 Twitter, and Trader Nick Twitter. I'm not gonna lie, guys. Has anybody else given up trying to call Twitter X.com? I have completely given up. Every time I refer to it, it's just Twitter now. There was a little part of me for a little while where I was like, okay, I'm gonna call it X.com. I can't do it. I just can't do it. Now, do I think it's gonna change back to Twitter? No. I feel like Elon Musk is, you don't become that wealthy and that successful without a good level of stubbornness. A good level of stubbornness is actually a really good thing. It's a constructive thing to stick to your guns, but I don't think he's going to change the name back. I don't know. I don't think he's incented. The dude has so much money that I don't think, even though, many people are clamoring oh, change it back to Twitter. I think he's like, I don't need to, and I don't want to. What's up for the Culture FX? Good to see you here. Is the A1 retail sentiment based on real positions? From which source? CFTC. Alum, good question. We have a couple people on our team. If you want to ask some questions specifically about the Edge Finder, we'll drop the link to our direct message center. We have some answers for you. The short answer is we draw it from a couple different sources all at once. We have a couple different brokerages that we pull data from. Sentiment is a really hard thing to try and track in the Forex market, especially. because it's not a centralized exchange. So sentiment, whenever you see sentiment in the FX market, it is a best guess because it's a small, whatever you're getting it from is from a sample size, but it's unlike the stock market where you can get, if you want to look at a good sentiment indicator, one that I really like, take a look at the put call ratio, which we should look at. This is a good case study. Look at the put call ratio, guys. And this to me is signaling a very nice opportunity. And if it becomes a bigger opportunity, even better. The put call ratio is a really powerful indicator that we added to the Edge Finder. If you have an Edge Finder copy, head over to sentiment, go down to put call ratio, and maybe you can follow along with this. I made this bigger the other day because I thought it would be a little easier to read. Let's discuss for a moment the put call ratio and maybe what it's telling us. So the put call ratio measures the volume of puts. Why did I put B? I meant P. The volume of puts and calls, right? And it says puts and calls. Puts are options bets to the downside. Calls are options bets to the upside. They're like leveraged betting. If you don't know much about options, people buy puts aggressively when they think the market is going to drop off the face of the earth, or if they want to buy insurance to their portfolios. There's a number of reasons that options traders will employ using puts and calls. But if there is a huge surge in demand for puts, the volume of those puts is tracked on the CBOE, where we can see what the options market is showing us, where we can see the volume of these things. This is a wonderful sentiment indicator. Now, when puts are heavily being bought, it is an interesting thing because it tells you fear is up. Now, puts have been not attractive to the market recently. Look at this very suspended time where the put call ratio was very low. What this signals when the put call ratio is very low, it tells you that market sentiment is very optimistic and doesn't foresee any sort of devastating, basically people buy puts as insurance or because they think the market's going to go lower. If there's a low demand for puts, it generally tells you that the market thinks we're good. There's nothing wrong. When the market sees a high put call ratio, that means the number of puts relative to calls is high. So there's a lot of people buying puts out there. And we can see that in recent times, this has been trending up. A lot of people buying puts. Now, in my personal view, when you get a big spike in the put call ratio, if I have other reasons to potentially buy the stock market, like, we can see the VIX popping up as well. That also is sort of similar to the put call ratio. Puts have gotten really popular. And now, where this was a little bit, if you're being contrarian with it, when it starts to get too optimistic, maybe you buy some puts, or, maybe at the very least, maybe you keep a little cash in the account, whatever you want to do. Maybe you just stay a little cautious on both sides of the extremes here. So the put call ratio jumped up to 1.28 here on the Edge Finder. And that shows us that, again, market sentiment got really bearish suddenly. And now that market sentiment, let's go take a look at the day. August 5th, okay? August 5th is this day. This is when market sentiment became incredibly bearish. Is that a signal that perhaps the low is in? Maybe. Maybe. I like the odds to the upside. That's why I'm long. If I'm wrong about it, I'll stop out, control my risk, and trade conservatively. So also, since I just dropped all this information about the put call ratio and all the tools that we build here at A1, my company A1 Trading is a software company based in Atlanta, Georgia. We build some pretty powerful, cool stuff for traders. We build software that things like the put call ratio, we track positioning, we track economic data, and we have a top setups algorithm that generates bullish and bearish readings for our favorite charts. We track everything from gold to currencies to other commodities to indices. If you don't have a copy of the Edge Finder in today's day and age, I'm telling you what are you doing? We'll do something fun here. If you guys want some information about our trials, we have 30-day trials available. We just dropped the link here in the chat. Thank you to the producers. So click this link if you'd like to fill out a quick application for information about the tool. you can do so there. You can get some information about the tool. It is not a free tool. We have spent a lot of time, money, and our life's work to build this sort of stuff. So if you are looking to get access to some of our powerful tools, you can apply for a trial here. And if you just have questions or you would just like to go ahead and consider purchasing the tool, we'll drop a secondary link to speak directly to one of our support representatives that is standing by. So we have a couple people in our office right now who are available to help if you have questions about the tool, if you'd like to get a copy. I'm telling you what, I mean this so genuinely. In today's age of trading, I think you need a tool like this. I personally don't think I could trade without the Edge Finder. After having used it for a few years now, there is just simply no way I'm going back. There's absolutely no way I will ever trade again without this sort of data in front of me. Because if I don't have this sort of data in front of me, I have to go read articles for like 6 hours a day just to try and keep up. Whereas with the Edge Finder, I can just click a data point that I want to study and boom, it shows up. Like here's job openings. I can go take a look at the labor statistics. If I'm worried about the labor market and I want to do some research, boom, I can do it all in the Edge Finder. So again, there's your plug for the Edge Finder. It is a very powerful tool that I think everyone should have a copy of. And that's the long-term goal for our company, is to try and make it available to everyone. So get yours now. We just dropped the link in the chat. The Japanese stock market leading things higher, up 6.3% on the day. The NASDAQ up 2.4%. Taking out yesterday's high is a good start. We'll see where this one wants to go. We'll see if this thing can go back and test this level that I've marked up on the chart. Again, I've got a fib retracement from the highs to the lows, which gives me this 38.2, the 50%, and the 61.8% retracement. It looks like it wants to squeeze up and test those levels today, or maybe tomorrow. We'll see. But today's start is very strong for the NASDAQ, for the S&P, etc. And even the Russell bouncing back really nicely today. I do have a long position on this one as well. Gold not doing so hot. So, I mean, it's doing fine. But let's talk about gold. Why isn't gold up 2%? Why isn't gold up, 2.3% like the NASDAQ? Here's the thing about gold. Gold looks good to me on the long side. I like gold as well. But yields are up today. Yields being up are showing a little bit of restored optimism about the US economy, which is not a positive thing for gold. Even though gold is up a little bit, it'd be up a lot if yields likely would be up if yields were, falling hard. And gold is just in a tricky place. Actually, I take that back. If yields were dropping, I don't know that gold would even be up today, because right now that would signal, okay, people are going to need to, if we had the Japanese yen rocketing today, gold would probably actually be lower because people would be selling gold to cover their margin in Japanese yen. That's my guess. That's what happened on August 5th. That's what happened when the kind of global margin concerns about recession, the Japanese yen, August 5th, gold market actually dropped. So you might think that is just manipulated and a scam. But if you actually know your history and you actually know how markets function, that move on gold on Monday made absolute sense. When there is huge global margin concerns, do not expect gold to go up. Even though, yes, that is a fear-driven event, you must understand that in the short run, let's say you're a hedge fund and you have big positions in gold, in stocks, in real estate, etc., right? If you have to suddenly cover your positions quickly, you need to raise cash in your account to avoid a margin call, which is what many hedge funds did. They have to sell everything in order to raise cash, even gold. That is why the initial concerns about a recession spiking, usually, historically, the playbook for gold is gold drops as people raise cash, and then gold rips if a true recession starts to form, because then people are like, oh, they're going to print a bajillion US dollars and euros and pounds, and I want some inflation, hedges, etc., or just very little, just wanting to be out of the system, the traditional finance system. But today, with the traditional finance system bouncing back, Japanese stocks up 6.3%, the Nikkei killing it, the NASDAQ killing it, S&P killing it. With these bounce back moves, concern is dwindling about the global economy, still there and still valid. I'm not saying that, bears were just silly for getting concerned. I'm not trying to pick on anybody, but I am thinking, okay, optimism being restored is not very bullish for gold, right? What's up, James? Good to have you in here. Your USD CHF trade, all out. We took profits on USD CHF last night, actually, and that ended up being... So let me be honest about my USD CHF trade. My USD CHF trade was not a ginormous position for me, but it was probably the best trade that I've had maybe all year long. So although I didn't make $1 million on this trade, the trade itself was probably one of my best trades all year long, if not the best one. From a pure risk to reward trade, let's think about this. We ended up hitting on this USD CHF short a 9-to-1 risk to reward. I think that's a little bit behind my gold trades this year, but still remarkable. And I'm not excusing my other horrible trades. I've had a really rough couple weeks. So my entries have been so off on the NASDAQ. I've taken a couple stabs at ETFs that I like, complete washes. So I'm not here to just brag about my winners only, because I've been dead wrong on YouTube publicly for a couple weeks now. It's been not the easiest thing, obviously, when you're a public figure in trading or the content space for trading. It is you get slashed when you're wrong, and that's okay. That's part of the game, part of the role that I've chosen for myself here, right? It's just part of it. But this USD CHF trade was actually a gorgeous trade. I didn't think it was going to do all this. This is why I love trailing stops. So I trailed stops. I had my initial stop here. When the market dropped from here, I trailed stops just slightly better than break even. Market rolled over further, trailed it here. Market ripped and then dropped again, trailed it here. Market ripped, dropped hard, trailed it here. And then I trailed it here. And then yesterday, during all the craziness, I put my stop loss just above the high of day. And sure enough, the USD CHF seems to have, at least for now, found a bottom. Am I looking to re-enter a short on the dollar Swiss? No. No, not right now. If I am going to look at a USD CHF short entry, maybe a return back to like 87.50 as a bit of a hedge. But I personally think that might have been it for the USD CHF trade. If what I'm saying about global margin concerns do subside, USD CHF and USD JPY may find bottoms in the short run. There's the dollar yen, made a spike down to 142 and has bounced back. The yen is something to watch. I've said this for the last few weeks. Once the yen finds a bottom, that's going to be a signal to other risk assets that perhaps, we're in the all clear again. But I don't know that we're there yet. So again, I've mapped out my plan personally, how I'm going to play this market. I'm looking for lower prices if they happen, but I am long currently. What I mean by that is I have cash on the sidelines that I'm planning to invest or add into my account if we see lower prices. But my lean is bullish on the markets. What about buying gold? So my thought on gold is this. I do like gold to the long side, but I am in no hurry. I have enough stuff going on with my other trades. But if we do see a rollover in gold, I've mapped out 2360 and 2300 as possible areas where I could try. And I don't hear a lot of creators talking about this in the trading space, but I always mention that when I have an idea about a particular trade or chart or whatever, these are ideas, they're not certainties. And I'm just mapping out where I personally would take some risk myself. I'm not telling anybody else to do what they want to do. You do your thing. But for me, I like the idea of maybe trying a gold buy around 2360. And if that completely flops, I'd probably try again at 2300. If that completely flops, then My idea was just wrong. And we move on. What do you mean when you say margin? Margin is basically just borrowing, like leverage for FX brokerages. You're borrowing money to trade. And the global financial system, there's a lot of borrowing at the hedge fund level that happens, right? They borrow from the Bank of Japan. So why do they borrow from the Bank of Japan? Because the interest rate is low in Japan, but has recently seen a bit of a tick higher, and expectations for other central banks in the world are to cut interest rates. So, the dollar has been falling off the idea that the Fed is going to cut rates hard. And recently, the expectations for even more aggressive rate cuts have come into the picture, causing the dollar index to really drop hard. But it seems like the dollar index may have also found maybe a short-term bottom here, right around this 102.75 level, 102.50 level. Wow, I did not think we'd be getting down to these levels on the dollar index this quickly. But it seems like the dollar index may be trying to find a little bit of a low here. I would be a little bit, I say this cautiously, but I think the dollar might actually have some short-term upside. You may see a bit of a bounce back in the US dollar continue, but then I get nervous again at that 104 level, where I was very bearish all during this time, bearish, because I was very long gold during that time. And then we took out those lows hard. Dollar bulls it's not been a fun time for dollar bulls or myself being long the NASDAQ. So I'm not picking on anybody, because I've been very wrong in recent weeks as well. But dollar bulls, dead wrong in the last few weeks. But, that's because we've had some surprising economic data coming out week. This is where people get so, like traders on social media who are new to this stuff, they will, pick on people when they're wrong. They'll be like, you were so stupid for thinking this would go up or this would go down. But how are you going to tell me you knew with certainty what was going to happen in the labor data last Friday? Like, you can't know that stuff for sure. You can have an expected, you can have a bias on things, you can have an opinion on things, but how are you going to tell me that you knew with certainty what was going to happen on the jobs data on Friday? Nobody knew that for sure, right? I'm not sure why the edge finder's loading this data slow. But anyways, that's my point is, markets are just difficult to predict. And the cool thing is you don't have to be a perfect predictor of the market in order to make money. You just have to not be leveraged. You have to be conservative with your entries, have a good back tested system that you're sticking to, and enjoy the ride. But it is certainly a ride, especially for me the last week. My goodness, a lot of you guys probably are in the same boat. Oil, similar to the dollar index, may have found a bit of a short-term bottom. And if we get some economic surprise out of the US, which one report that I'm looking forward to this week is tomorrow's unemployment claims. Thursday's unemployment claims will be really important to the market. Previously, we saw 249,000 unemployment claims. Forecast for this week is 241. And what comes out from that report will be really important. Oil, there's some positives and some negatives here for the stock market view. Positives are that, anybody notice the gas pumps prices are going down? It's because oil is on the way down. This is good for the inflation story. Inflation caused by oil is no fun. And oil prices going lower is good for the inflation story, not just in the US, but globally. That being said, Saudi Arabia and other places, they don't love seeing oil prices go down too far, because they want to make money and they want to sell it. So a lot of times what they will do in response to oil prices falling too far is OPEC nations will reduce the supply that they let into the global market purposefully to raise the price. So to me, if you're looking at oil on a global demand perspective, you're saying, I think the economy is going to get weaker, then yes, we could see potentially a push lower, maybe down even into 70 for oil, especially if you think that the economy is going to really weaken. that would be a global demand hurt. But for me, I kind of see oil as more of a possible, we're closer to a bottom than we are to a top. And the reason for that is because I think that, again, you have OPEC, which may choose to kind of play some political games to try and raise oil prices. And at the same time, you may also have some upbeat economy numbers. I don't think that the economy is going into a recession right now. That's my opinion, and it is an opinion. I could be dead wrong about that, but that is my opinion. So that actually would tell me that perhaps oil prices are relatively low. That being said, if you're looking at like the 4-hour chart, it's kind of ugly. You got lower highs, lower lows. So, if I was to actually take a trade on this, which I don't really intend to right now, if you started to see something like this, started to see a 4-hour chart breakout, something like that, maybe there's something there. But for me on the Edge Finder, I don't think oil is giving us a bullish view because economic data has come out kind of weak recently. Yeah, so oil getting a neutral reading. So I'm not going to be buying or selling oil. I'm just going to be neutral. That being said, if dollar Swiss does rally a little bit, I might take a hedge or a secondary position on USD CHF again. Nas up 2.5% and nearing that level of what I see as potential resistance for the day, right around 18,600. Will a 10-year auction at 1 p.m. move the markets? Likely, yes. That's probably the event of the day, actually. Do you mean the 30-year auction? Bond auctions have been increasingly interesting in recent years because bond prices are, on historically pretty low. But the question is, what do bond actual investments, people who go, bond auctions are a physical, thing. People go and they buy bonds from the US Treasury. What they pay for those bonds gives the market some sentiment about, where things are at. If there's strong demand for bonds, it's kind of tricky because right now I think it's weird, but I think a really strong bond market auction would actually be a little concerning for stocks because then it would say, oh, bond investors, strong meaning yields would come down, right? I think the market actually does not want yields to come down. They want the economy to look strong, which would signal that you actually want yields to kind of normalize. It's okay for yields to come down for the rate cut story, but you don't want them to crash lower because then it's like, oh, we got a growth scare. The economy's slowing hard. Chris Pulver's up next. Cool. Got Chris Pulver coming on in just a few minutes, guys. If you guys are enjoying the show, if it's helpful to you, do me a big favor, hit that thumbs up button on the stream. It really does help just to, help out what we're kind of trying to do here. Spread realistic trading, no nonsense, no Lambos, just trading. Russell's up 1.5%. Nikkei is up 6% on the day, and the VIX is down just shy of 20%. Look at that VIX. That is an ugly chart. VIX popped up to 65, dropped way back down to 22.4. I am long also SMH, which is another chart I'm watching. We'll see what happens with the semiconductor stocks. If the economy holds in there, I like the risk to reward on these stocks. Obviously, if the economy does not hang in there, if you get a lot of weakness out of the economy, semiconductor stocks in general could go lower. But it's all risk to reward in trading. That's it. At the end of the day, it is all about the risk to reward, not the certainty. So nobody knows what's going to happen with the market for sure. It's all just educated guessing. Thank you very much for the kind words, Nikki FX. Appreciate you. Yeah, so for gold right now, it's really just in a no man's land for me. It's really choppy. I don't mind the idea of picking up some gold if we get better prices or lower prices, but I struggle to be like, I'm not jumping out of my seat to buy gold. I do have a bullish reading on gold on the Edge Finder. If we go to the top setups page, gold is giving us a bullish reading, but I'm just going to try and wait and stay patient on this one to try and buy gold when if it gives me a discount. So we'll see. Nas and S&P are both up over 2% today. The Dow Jones holding in there 1.3. Russell's up 1.6. Come on, Russell. Let's see it happen. Russell would be nice to see really take off. In fact, I'd have the most confidence today if the Russell was leading the other two or the other three. It's leading the Dow, but it's lagging the S&P and NASDAQ. What would be very bullish to me today would be the Russell taking the lead. If we see the Russell take the lead, you got some sweet spots coming, in my opinion. As always with this stuff, guys, trading is high risk. You could lose a lot of money very quickly. I've been there, done that this week. So please understand, trading is risky. You got to be careful with this stuff. And whatever you're doing, please make sure you're being responsible. You know, in today's age, it's very easy to open up a brokerage account and start throwing trades around, and it's so easy to lose a lot of money. It's easier than ever for the average person to lose money in the stock market or Forex market or futures market. Take your pick, doesn't matter. People lose money like crazy in this stuff because they don't approach it with risk management. They don't approach it with a plan. They've never back tested before. They've never studied strategies. They've never studied fundamentals. And unfortunately for a lot of people, it takes either blowing up all their money to learn that the hard way. And some people never even learn it. Some people just say, oh, no, stuff's a scam. I'm going to walk away, and they quit. So, yeah. Nick, you bought 25% of your portfolio on Gold Friday. Does that mean a huge loss on the P&L? I did take a loss, yes. But when I say 25%, if you have a $100,000 account, let's just say, and you buy 25%, so 25 grand worth of gold in stocks or, a cash or margin account, consider this, let's just say it's a cash account, $25,000. And let's say you risk 1% of that $25,000 position, that would be minus 2.5K, which is a 2.5. I'm sorry, I did that wrong. If I risked 1% on the account, or it kind of breaks down. You got to do the math independently. So a $25,000 position on a 100K account may sound like a lot, and it is, but I'm not risking 25% of the account. I'm allocating 25% of the capital of that account into a position, but I'm not losing that 25 grand if I'm wrong, right? Does that make sense? Hopefully it does. If I'm risking 1% of that 25K, that's $250. Is that right? Is my math just off? No, it's 2,500. Anyways, yeah. So NAS and S&P up today. Nikkei's up 6%. VIX down just shy of 20. Again, I don't want to try and say for sure the bottom is in, but there's some good signs to say we've got some aggressive buying going on. And we'll see if it lasts. We'll see if we can start taking out these levels that gave us some headaches on the way down. Let's see if we can start breaking those structures. That's your signal that the bottom would be in my view, way more confidently if we take out these levels and start putting in higher lows. Then I think you've got something material. But I'm not waiting for that signal because I liked this level, right? I liked this level. I didn't wait for confirmation, and I didn't buy it here. But I bought, once the market started rallying, I went and jumped right in because I saw that level and I said, that is a good reaction here. And I'm willing to take the risk. If I'm dead wrong and this market crashes lower, the risk to reward makes sense. You have to understand, Many people focus so heavily on I need to be right. If I'm wrong, I can't stomach it. I can't handle being wrong. I don't want to. Drawdown hurts so bad. People are so afraid of drawdown or being wrong that they forget what trading is really about. It's about risk reward. It's about when you put a stop loss on a trade, you're accepting it could get stopped. I could get stopped out. If you can't accept that, don't put the trade on, right? But you have to say, does the risk make sense relative to the potential reward? You can't just focus on reward in trading. That's the newbie mistake 101. People just focus on the reward. How much am I going to make here? I've got to be right. It's going to go up from here. It's going to go down from here. Can't do it. That is a quick way to lose a lot of money. If you're afraid of losing money in the markets, it's not going to work out. Now, I'm not saying you can't I'm not saying go be a degenerate and put all your money on and be, can't be afraid of losing. No, I'm saying responsible risk is how you make money in the markets. There's no other way. You have to put risk on in order to make money, but how much risk you put on is up to you. That's your personal preferences. That's your personal tolerance. I personally, on a percentage basis, have a low tolerance for risk. On a P&L standpoint, it may not look that way, but from a percentage standpoint, absolutely, I have a low tolerance for risk. I'm not looking to have 50% drawdowns, 60% drawdowns, which a lot of people who are trading small accounts are willing to accept. For me, I'm not willing to accept that. How do I avoid it? Position size down. You can control, you might not make as much if you're right, but I'd rather stay in the game than lose it all trying to go heavy. Anyways, guys, we're going to take just a quick break. And then after this, Chris Pulver's going to take over the stream. Going to give you guys some words of wisdom. So not words of wisdom. I know that guy's super popular. I actually did an interview with him. So stay tuned on that. But we got Chris Pulver taking over the show just after this quick break to share his thoughts on the Nikkei up 6% today. A little bit of a bounce back day for sure, to say the least. So we'll see if it can hold. Yesterday, it looked really good. And then the close came. So we'll see if this market can hold its gains, hold its ground from here. Stay tuned. We'll be right back just after this. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Hey everybody, how we doing? Happy Wednesday, I believe. Yeah, yep. Happy Wednesday. Nice to be with everybody today. Just finished up a really solid session, just talking through everything. I want to make sure, and maybe all of you out here know this, but does everybody know what just happened? I thought that was important to just spell it all out, get it all out there. And I also found some really interesting similarities. So I have some thoughts. And what we just experienced is definitely an outlier event, and it's a vol expansion event or a volatility event. The closest thing that I can find to this, and I'll explain all this in a moment, the closest thing I can find to this is what we had back here in 2017. Okay. Now think about this. We had a pandemic crash in 2020 for about a month, and this vol event occurred here, but different circumstances. Okay. The closest thing I can find to what just happened for us here in the market from last week, Thursday, Friday, Monday's open, is probably the same that we have right here from most of 2017 into 2018, early, like January, February 2018. Because if you were watching or trading in 2017, does anybody know what record 2017 did in the S&P that it's never done ever in the history of the S&P? So for about 100 years, all right, what happened in 2017 has never happened. Still to this day, it's only happened once, and it was 2017. Does everybody know what that was? Okay, what happened in 2017 was every month higher high, higher high, higher high, higher high, higher high, higher high every month. Every month for 12 months, the S&P never had a losing month. Crazy. It's never happened in the S&P's history ever, but it happened in 2017. Okay? It was super low volatility, and this market just slowly melted up all year long. And then what we had is we had a volatility event in early 2018. This is the closest thing I can find to what we just experienced. Now, there's a big difference. Okay. Now, did we unravel a carry trade? Was the Nikkei dumping and all? No. Like that was I think why we had the catalysts were lined up the way that they were. The market was reacting to the Fed's unemployment print on Friday, so maybe the SOMRO was coming in. You had the inverted yield curve, which is getting closer and closer to back to normal. You have the Nikkei dumping the largest 2-day drop in history. So all these things add up. But the point is, this is a volatility event. And what I want you to pay attention to, okay, is in 2017 when this happened, I want you to see what this VIX actually did over the next 30 to 60 days. Okay. I do have what we're expecting to see over term structure in the VIX, which is we're sitting here around 2236. Aha, this is interesting. Look at August, September, October, looking for a slight uptick in volatility before we go lower. Like the shape of this term structure chart has changed over the last couple of days. All I'm saying is if you look at the chart for the VIX, okay, we had this big volatility event, and this is a daily chart, by the way. So this is another one of those crazy moves where from a close here to a rip to the upside, that was 125% in one day. Well, we did that this week too. Monday was 180% from low to high. It was like a 300% rip in 3 days trading on the VIX. It was nasty. But this was a move from this low to this wick high was around 270%, and we were just over 300% from Friday. It was Thursday, Friday, Monday was over 300% for this week. That's why this is a bit of an outlier, but this goes right in line with what happened in early 2018. So what did we do after that? Well, we retreated pretty aggressively, right? We get to these highs around 50. We retreat all the way back down to 21. And then we also have another spike up in volatility. I just want you to be prepared for the next couple of weeks to not be just a permanent up, the bottom's in, the market just goes higher, because we obviously have some levels we need to pay attention to. Okay. So the S&P right now, let me go back to the daily chart. S&P right now, look at where we are. To me, this would make sense if we have this high, this low. We had roughly a 10% correction. We were just shy of that 10% handle. If we pull back to this level right here, that would be pretty perfect for efficiency's sake. To have a high, have a low. I mean, if you want perfect, let's go 50%. Let's find exactly 50% on this high to low correction. So take the high, take the low, and we've pulled back about 38% right now as of today. So if we have the ability to kind of keep this melt up happening and get to this 50% zone, that puts us right around 5,400. I would write this number down, 5,400 on the SPX. Why is that an important number? Because if we hit 5,400 right in here, that is the make or break for this market. Okay. The break would be that volatility returns, and what goes down has pulled back and then could go down again to possibly fresh lows, or to have some type of maybe retest of the low, or try to have some type of high, low, and maybe it's a higher low. A lot of traders would be hoping it's a higher low. If it is a higher low, great. We put in a bottom, we have a reversal pattern, freaking sweet. If we come back and retest the low, that's what volatility does oftentimes as well. We have this big event, we rip our way up here just because everyone is caught off guard and caught with their whatever, caught with their pants down essentially. um, and then the market's like, okay, well, we respond from that to like aggressive buying, and then that gets faded back down. And I'm telling you, like, don't be thinking that this market can't test these lows again. It absolutely can. And what's going to be important is how this price action behaves over the next 30 to 60 days. I know that seems like a long time, all right? But as we talked about this week, 10 years out from now, 20 years out from now, none of this matters. If you're an investor for that long a duration, most likely you're going to be fine, okay? But for right now, over the next 30 to 60 days, as an active trader that does this every single day and I'm in the trenches, this stuff matters because how I get positioned and how I manage my risk and how I manage some profits all depends on how this price action plays out in the near term. All right. I have some expirations that I'm watching very closely over the next 10 to 20 days. That's what I'm essentially looking to survive. But I'll be watching. So Wall Street gains second straight day, little BOJ assistance. That's because the Nikkei is up quite a bit again today. Nikkei is up another 1%. Okay, so 1% as far as closing on the day, but the low to high candle. So we actually gap slightly lower. We had a low on the day, high on the day of around 5%. Nikkei is the same situation. Okay, if you look at the Nikkei 225, I think, and just based on the price action that I see, we have this trend line way out here, which is going to be an important one to see if the bulls can get back above it. Okay, that's a big one to watch. But more importantly for me is if we have this high right here, because this is where it got really ugly. When this carry trade unraveled and unraveled quickly, okay, it all started from this area right here. So this is the level that I'm watching the most because we pulled right back into this pocket. Right? Look at how the Nikkei closed today. Although we were up on the day, look at how it closed. It closed with a pretty nasty like end of the last hour of the trading day for Asia was rough, I think. Now, based on some just pure price action, common things the market does, when we have this type of fast aggressive move, there's no left structure to go off of. So this could be potentially a cup and handle pattern, which looks like this. Okay. And then looking to see if this will pause and then break and go higher. That's a cup and handle. So I'm still looking to see if this is a possibility. All right. The levels I'm watching very closely would be right here. I think this level is a critical spot for the bulls to defend. Area 1. Okay, around $34,000 on the Nikkei. If that level gets defended, if we come back into that level and buyers are interested in taking this back up, I think that is a great sign to see that this Nikkei has put in a pretty nasty but pretty stable low, and we go up from here and we start going after this pocket. We start going after that gap. And if the bulls get there, awesome. How long does it take? I don't know. Maybe it takes a couple weeks. Maybe it takes the next 30 days. I'm not sure. But if we break below this level, if we break below 34,000, my concern is that volatility returns and our VIX goes up like this, and we have a couple days pulling back, and then the VIX starts to get higher. Now, I don't think the VIX is necessarily returning to 65. I don't think that's going to be the case unless we get worse. Unless this Nikkei wants to make fresh lows and there's more to unravel, that volatility can get higher. But I do think that in kind of this outlier volatility event, we have a slightly higher move coming to volatility, meaning like we go correct, we come back up, and then we work our way over the next like 30 to 45 to 60 days. We start working our way back into like the low 20s or the teens in volatility, which kind of stabilizes things. But we expect to see some reasonable day-to-day swings. All right. So this level at $34,000 to me is really important to watch because if we break below that and the bulls aren't there to show up, then this looks like a retest of the lows. And that would be my second level that is extremely important for these bulls to step in to defend. Because if the Nikkei can defend one of these two levels, then it calms everything down for the US to stabilize as well. If the Nikkei breaks these levels, I'm sorry to say it, but it's probably going to drag the US market down with it. Now, maybe it's dragging the US market down with it in corrective territory, but it's still likely going to drag the US market down with it. So let's just recap this and I'll go to other charts. If the Nikkei just keeps melting up, totally fine. I don't care. Okay. And it sucks that it happens the way that it did, that it was just like this V bottom. We had some flash crash moves on the Japanese yen, some flash crash moves on the Aussie, flash crash moves on the Swiss franc. I'll talk about those in a moment. Okay. Actually, I did spend some time in the Swiss basket today. I really like what the Swiss basket has been doing. I got filled on a couple of really big lows. I've actually got some really nice profits. I'm moving my way up. I'm changing my profit targets a little bit, and I'll talk about that. But I'm going to let the Swiss pairs run. When we have these big bottoms, these flash crash moves, and we haven't had one since 2020. And I don't want to say that like that's a good thing. It's like what happened on Friday to Monday, it really shouldn't happen. If these markets are truly efficient, and think about this, you hear this like, just go with the efficient market theory and just buy the benchmarks and buy the ETFs. You can never time the market. You can clearly see these markets have events where this is not efficient pricing. Okay. So there are opportunities to exploit that. I mean, Frank this week had 1,000 pip profit on inefficient pricing because he had a way out of the money put option that paid him 1,000+%. That shouldn't happen. Efficiency wise, everything stays within one standard deviation, and you've got a 68% chance of this move happening. And then you go one standard deviation wider, you got about a 95% chance of that happening. We went outside of that. We had like 2.5, 3 standard deviation moves. That's not normal. So these markets are mostly efficient, but when they're not, they can be really freaking nasty. All right. And for any trader out there that had a rough weekend and a rough Monday, I feel you. I had a lot of profit that went from. I mean, I was up almost $200,000 for the year, and now I'm up about 40. I didn't lose, but I'm sitting in unrealized positions right now, which I'm just sitting in a drawdown, which sucks. So am I trying to work my way through it and manage it? Yes. Can I do it? Am I confident I can do it? Yes. But I'm getting more aggressive on if I have to, put myself back against the wall, back into a corner. If I've got to hedge my way out and hedge my way through things, I will. But I will be fine. But man, it was not pleasant. And I'm a pretty conservative trader, and I'm a very responsible trader. And I feel like what just happened was enough to bust up a lot of people's accounts. I had mentioned this yesterday. I mean, the Tasty Live Network on Monday, they canceled their typical programming and they just sat there with two 40+ year veterans and just took people's calls and just tried to help them through positions. When somebody calls in and says, "Hey guys, love what you do. I've got a $150,000 account. I'm actually down $130,000 right now. What do I do?" That was Monday for a lot of people, right? That's what sucks. That was Monday for a lot of people. And what could you do about it? Not really a lot. That's what makes it even more frustrating. So enough of the rant. Just trying to explain like this is what traders are dealing with. And if you were hit, if you had a drawdown, if you had nasty losses, you're not alone. All right. Unfortunately, this stuff happens in the markets. This is why we take risk. But the one thing that I will say, and I've been through flash crashes and I've taken big losses and I've worked my way through them, is if you are a trader that knows the process of making money, what you can do most of the time is just keep making money. You know how to make profit. You know how to generate wins. So keep doing it. So if it's an unfortunate setback, it freaking sucks. But you know what got you there and you know where those profits came from, you got to do it again. It's like it can be frustrating. But if you're generating income or generating profits or, growing your retirement accounts, however you're doing it, keep doing it. There's no better vehicle to generate, profits and long-term compounding gains other than what we're doing here, you know? So anyway, that's my PSA for the day. Um, yep. Okay. So quick recap on the Nikkei. 34,000 is really important to watch. I don't love how the Asian market closed since we filled this first gap. I could see the market testing. The bulls need to step in at 34 because if they don't, we're possibly going to come back and retest the lows at 31. I want to be ready for that. I'm going to be braced for that. I'm watching for some volatility. I'm hedged because of that. So that's going to be important to see how this unfolds for this week and next week. All right. It's already Wednesday. This market can kind of shrug off a little bit, but the volatility index is okay. We're at 23. Does this spike back up? It would be very easy to see what rips up here, falls all the way back down, comes back and elevates into the 30s again. That is not going to be a pleasant feeling for a lot of traders. If we get back up to these levels, I don't think we're coming back to 65. I really don't. Right? You can go back into all of the levels. Anytime we've had this big one-off event, that's the high. 2020, this is crazy. I keep going back to this, but these are important lessons you got to draw from this with trading. Okay? If you go back to 2020, we did have a crazy volatility event. Okay. But it happened over like a 5 to 6 day window. So we just had, spikes from 22 into the 40s. That was a big one, but that took 5 days. Okay. Then we pull back and then we go from 25 into the 50s, took 5 or 6 days, pulled back again, goes up into the 80s, took another 5, 6, 7 days. So that was because nobody knew what was going on. Nobody knew what COVID was going to do. Nobody knew what the global shutdown was going to look like. That's why it was just like steady, 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 crazy volatility. But when it was done in a month. Like from one OPEX cycle of February to March, this thing was done. So when it finally reached those peaks, it was done. What we had back in this 2018 vol spike that I talked about earlier, this was a one-time spike that then made a lower high in the VIX. I think that's what we're dealing with right now. I think we had a one-time spike, but I do think that this VIX can still make a post to the upside. Okay. Ryan says, you have options tutorials? Yes. I do private coaching, Ryan. I have a bunch of videos on my YouTube channel. You can just search on my YouTube channel for Options 101. Check out a couple of good videos to kind of get a base case on how to get get some options knowledge. Yep. So I'm looking at the volatility index to, probably head up, and it might be a little painful, but what's going to be important to watch is, are we actually breaking structure? Are we retesting these lows we had from Monday's open? If we are, buckle up. It's not going to be pleasant. You just hope that the lows hold. Okay. But if we, have a little bit of a lower high spike in VIX and then we come back down and settle, great. The nice thing about right now, and Nick said this yesterday, the nice thing about right now is that we don't have a ton of news, right? And so that lack of news, that lack of major catalysts out there is enough to kind of keep the market pseudo calm, right? Because after an event like Monday, if it was like, oh my God, we've got CPI this week and we've got another FOMC and we got another this, it's like that would just fuel all this uncertainty, volatility, hedging, all this other crazy stuff. And you just have chaos in the markets. But the fact that it was like done by Friday with non-farm, Monday was a crappy day as far as like what this one-time event did. And it's an outlier. This is the largest single day, or the second largest single day move in 34 years of the VIX. It was the largest 2-day sell-off in the Nikkei 225. It was one of the biggest volatility days we've seen in a single day, or at least a 2 or 3 day stretch in Forex. It was a flash crash, right? Like this is never a pleasant thing. But believe me, as I can go back and recount 2008 and 2011's downgrade, and 2014 oil, and 2014 dollar, 2015 Swiss National Bank, and 2016 Brexit, and 2018 oil and vol event, 2018 after a crash at the end of the year with a rate hike cycle, and 2020 COVID, and 2022 deleveraging. That's on my mind. You can remember all this stuff when you trade through it, right? So there's lessons that are burned in your brain to make sure that you're trading to protect against it while also planning for profits that you typically take. Okay. So this week we do have a lot of earnings, and I have taken 0 earnings trades this week. And usually I'm pretty much all over earnings and I'm pretty active and aggressive. But to me, this is more like, okay, portfolio, you're the focus. Let's hedge. Let's protect. Let's be watching everything pretty carefully. That's what I'm focused on this week. Okay. All right. So, good on volatility, good on the Nikkei. Watch the levels, currency strength. This is another thing to watch. Okay, the last couple of days. This is yesterday. If you see for me, this is currencystrength.com. The blue line is Japanese yen. The brown line is the Swiss franc. If we see like today, I was watching this last night, right around 8 p.m. Eastern time, 9 p.m. Eastern time. Asia session. If we see the Nikkei getting weaker, that is a good sign for this to continue to calm. Okay. If we're coming into Thursday, Friday this week, and we start a fresh day, or this, this could start today hypothetically, but if we start to see the Japanese yen and the Swiss getting stronger, that's where volatility starts to make its way back up. Just telling you. All right. I mean, look, if you're out here listening, this is important stuff, right? My entire portfolio right now is based on this. Okay. This is important, because this will determine how I survive the next 30 to 60 days and probably buckle things up and tighten things up for what's likely going to be a wild rest of the year. October, typically we see a Q4 rally, but you're dealing with an election. Who knows what type of drama that's going to come with? If the recession talk gets more and more heavy, if earnings season is good or bad for the U.S., it's all feeds into the same thing. It's all wild and crazy circus that we're trying to navigate. All right. But this is what's important to watch. So, all right. I do want to get into some Swiss pairs, dollar index. I know a lot of you ask about the dollar every single day. You ask about gold every single day. The dollar to me is, I think there's an opportunity on the dollar. I took this down to a smaller time frame. Let me just get the bigger picture first. Okay. So daily chart, weekly chart doesn't really matter. But the thing I see on the dollar right now is this: we have higher lows and we have lower highs. I am truthfully not that interested in anything on the dollar until we're outside of this triangle pattern or this wedge pattern. The easiest trade for me, and I said this, I said that 104 was a key level, but 104 was a 2-day break that is now pulling back. And so when I take a step back, and this is what's always nice about just going to the higher time frames, I don't see that there's a lot of confirmation to be a bear on the dollar right now. I also don't see there's a lot of confirmation to be a bull on the dollar right now. This, to me, this is the best trade in the dollar basket. Get above this level or make some fresh lows outside of this wedge. What this tells me is that through this summer, through the rest of August, through Jackson Hole, coming into the September rate decision, this is most likely going to be the catalyst for the dollar. I could see the dollar doing absolutely nothing for the next 30 to 45 days, and we have to get through the Fed in September before this thing starts to actually make a break. And this is twofold, okay? Because the Fed is cutting rates, and because the Fed is cutting rates probably consistently for the next 12 to 24 months, that would likely be the market's ability to price in a weaker dollar. And this is the buy the rumor, sell the news. I thought that the dollar would get weaker ahead of time, okay? But the dollar's been resilient because we've had some risk off tone. Not as strong as the yen, not as strong as the Swiss, but the dollar's been stronger across the board. Like the Aussie dollar, if you look at it, it's choppy. Euro dollar, choppy. Pound dollar, choppy. Dollar CAD, choppy, right? All of them. New Zealand dollar, choppy. So my point is, there's a lot riding on what this Fed does and how this market prices in these rate cut cycles. Because with a weaker dollar, with consistent cuts for the next 12 to 24 months, if we have more of a, last couple of innings of an expansion versus full on cutting during a recession, that's a very different trajectory for the S&P 500. We talked about this. Historically speaking, with a Fed cut cycle, if the market is in an expansion, okay, the S&P performs at a 10% clip for the next 12 months. That's average, okay? But if we're in a recession, which is what was being discussed last week because of the SOM rule, if we're in a recession and the Fed is cutting, the market is down 15%. 15% on average. Okay? That's the pivot that the Fed is dealing with right now. I don't know what the dollar's going to do, but this is what I'm watching. If the dollar is going to break and be priced in with weakness, this to me is probably where most of you out there are going to be happier traders. I'm just going to say it right now. If the dollar gets weaker, all of you are going to be happier because the stock market probably goes higher, gold probably goes higher, Bitcoin probably goes higher, risk appetite is still out there. We're still in this final stretch of the expansion phase. There's maybe some buybacks, there's maybe some more fiscal stimulus. All these things are good. Okay? That makes trading for all of you way easier. I promise you, it makes it easier. If that doesn't happen, and this dollar does not get weaker, and we see a dollar get stronger, and we see more out of the Swiss and more out of the yen, and it's all risk off in the currency market, which translates into risk off in the stock market, most of us are not going to like it, okay? Unless you are hedged accordingly. Unless you are trading more short term where you're in, you're out, you're scalping, you're picking your battles, and you don't have that overall portfolio exposure and portfolio risk. All right. I'm going to be in this camp on the upside if the dollar's getting stronger and this all goes like if my entire portfolio is down, I don't have a delta neutral portfolio. All right. I have a bullish bias. This is a positive drift environment on all the major indexes. When things are up, it's easier to not fight the market. Okay. But when things are down, you don't know if we're going to get these little 3 to 4% pullbacks or we're getting freaking 10% pullbacks. We don't know if the bears are going to jump off of a cliff instead of just falling out of a window. Because a window, maybe it's a 2-story window where they can fall and find the ground. A cliff, who knows? And that's the scariest thing is we don't know how low it can go. And we don't know how fast it can go. Okay. We do know that the market will halt around 7%. But guess what happens when they resume trading? More selling. And I don't want anybody to have to experience that because it's not fun. Okay. I was just getting into like serious trading in 2007, 2008. And I was trading currencies and it was easy to just read a chart, like one chart every single day, 200 pips a day in the euro dollar. I can grab 10 pips a day. I can grab 15 pips a day. That's a totally different mindset than sitting here with millions of dollars under management exposed to these instruments. So I am constantly trying to figure out where I can make money, how I can protect, and always playing defense. It's heavy defense for sure. All right. Okay. Let's see here. The Sheck family's asking, what's your best trading year so far, P&L? Percentage wise, my best gains. I mean, I'd like lightning in a bottle one year. It would have been 2014. My annualized gains over my career has been about 18% a year. Like net performance, net fees, all that stuff, about 18%. It's pretty good. But my best year, my lightning in a bottle year was 2013 to 2014. I was up around uh I mean the number is ridiculous. I was up around 400% across the board. Between currencies, between stocks and options, I was up like 400% in my portfolio. I took a decent chunk of money and made a lot more money. I've never had that gain ever since because once I got to a level where it's like, all right, look, this is some pretty serious cash I'm dealing with now. Then it became what's more realistic. Let's take some less risk. Let's be happy with like those 15s and 25% years because now I can compound. I can live off this income. So I didn't have to have like crazy high expectations, and nor did I. I just traded, but made really good money, and I was just crazy confident that year. The system I was using, the strategy at that time, I couldn't have asked for a better environment. And I'll admit, like I was lucky because of the environment. But I did recognize that as I made enough money, it then became a different style of trading. Risk less, be consistent. Now I can make enough to support myself on 10, 15% a year. That was it. So that was my greatest year. As far as dollar amounts, as I've grown into managing some capital, my best year was around $2.5 million in profits, and that's for everybody. That's just my piece is a little bit of that, but about $2.5 million. Yeah. So there you go. In case you're wondering. So, and look, at the end of the day, it doesn't matter. It's like I could have seen $2 million become $1 million yesterday or Monday. If I was a more aggressive trader, I could have been like I could have blown up an account. I could have blown up millions of dollars just with pure leverage and volatility. It's crazy stuff, right? So anyway, anybody have any questions on the dollar? On the dollar. I don't think the dollar is ready to do anything yet. Okay, I don't. I think if you're interested in taking a stab at the dollar, this is what I'd be watching for. This is why I have a trend line here on my chart. This is the DXY. So watch your dollar pairs. Okay. I would like to see the dollar do this. I would like to see the dollar, this is a nice little inefficiency right here. Okay. If the dollar starts to break, I think we could take a stab at some dollar weakness and take a trade here. And then potentially, if it pulls back and retests this pocket, take a trade here with a very tight stop loss right above this 104.25, 104.50 area. All right. And I say that because we broke this level. If we come back and retest, I'd like to see the dollar get weaker. And that would be that risk off tone that or the risk on tone rather that I'm talking about. And I think the dollar is going to be like the market's sacrifice in order to sustain a rally for the rest of the year. If we're going to even come close to sniffing all-time highs, I think the dollar has to get weaker. I've said that for months this year because I do think it's an important piece of risk appetite. The dollar has to get weaker, right? The dollar gets a lot of mileage out of talking. The Fed gets a lot of mileage out of jawboning monetary policy, right? Meaning they don't actually do anything, but look at what we do every single month. FOMC, meeting minutes. We revolve entire sessions around what the Fed's going to do, what the Fed's going to say, what the market's going to do to react to it, because the US is 60% of the entire world's market cap. It's a big deal, right? But the Fed can just say nothing and the market's trying to figure out what to do with that, right? Or the Fed can say something and the market's trying to figure out what to do with that. So right now the Fed has gotten miles and miles and miles of, the stock market's at highs, the dollar's been at bay, risk appetite's been pretty healthy. There's been some indecision out there, but this is now the turning point where it's like, okay, volatility's on the cusp of like blowing things up a little bit. And now the Fed is stuck in a corner where it's like, you idiots, you guys messed up. I said the Fed was going to break something, and the Fed didn't necessarily break anything. The market itself was just over its skis with leverage because of everything with the Japanese yen carry trade unraveling. It was a crazy kind of perfect storm of just stuff bubbling under the surface that just it snowballed really quickly, right? But now the Fed is being pressured into 50 basis points in September, right? Talking about go in and take emergency cuts and get this out. Stop. Like that would be, and we said this all week. That would be a terrible decision right now. If you talk about putting fear back in the market, go ahead, Fed, cut 50 to 75 basis points. Make an emergency cut before the September meeting. That's not going to give the market any confidence. All that's going to do is that's going to be a short-term save. Unemployment is going to rip higher. We're going to be in a recession, and it's that quick. If we have an emergency rate cut, it's a terrible decision. Look, I'm not a Fed speaker, right? I don't work for the Fed, but you could argue that 12 people, 12 central banks, or 12 Fed banks, or 12 members in the Fed with one major person like Jerome Powell, they shouldn't have the power to influence the market the way that they do. But they do. And that's why the saying is don't fight the Fed. So I hope, for the sake of market stability, that the Fed just does what it keeps saying it's going to do. It's appropriate based on the data. We can start cutting in September and do it by 25 basis points and freaking stop. Like 25 basis points, maybe again in November, 25 basis points, maybe again in December. That's a lot of cutting, right? If you think about it, the Fed usually only cuts every quarter. Does that make sense? The Fed only cuts once a quarter. That's what's been historically accurate. They will cut in March, cut maybe in June or July, and then in September, October, September, December. So to have a September, November, December, if we cut 3 times, that's a lot. That's aggressive because it's not spaced out. So that's why I do wonder if September's on the table, December's on the table, and November is like maybe because it's an election and it's 2 days after the voting. I don't know why they would put that noise in there, but they might. Who knows? So anyway, back to the dollar. I do see an opportunity here to have a dollar drop. All right. Now my stop loss is above this 104, 104.25 zone. The bigger picture is if the dollar gets outside of here, that's an awesome opportunity for the dollar to get way, way weaker. 101 is a big target for previous support, and 100 is a bit of a milestone. If we get to 100, that's a great run on dollar weakness. And if we break below 100, I mean, this could be a pretty exciting like capitulation move. We could have a blow off top to surprise everyone to the upside one more time until the dollar's maybe beat up enough that it's time to start stabilizing. Maybe. But I'm curious on this whole central bank thing with the race to the bottom. How ridiculous does it get? I have no idea. But I think we can safely say that these central banks are done raising rates, right? The Fed's been wanting to be done for a while. We're servicing debt to the clip of $1 trillion, right? Like $1 trillion is our interest expense now. That's insane on $35 trillion. So, I mean, the debt thing, it's a problem. It's going to be a problem that someday it has to be accounted for, maybe creatively, maybe realistically, who knows? But there's an opportunity on the dollar. Go back to the higher time frame. Does this make sense? So this isn't just like, oh, he doesn't have a decision. He doesn't know what he's doing. There's no clear direction for me right now, right? I talked about this 104 handle. I think that was an important spot. But the fact that it broke and it did it in 2 days, I'm done, right? Like I don't trust that this is like the move. August is also a very weird transition month in currencies. So if we have trends, they typically end in August. If we have sideways consolidation periods, they tend to end in August, right? So I'm looking to see if we have a breakout happening on this wedge pattern on the dollar. Because if we do, easy to trade it. If and when we have a breakout, we're probably going to have a much easier path to this side or this side to be a trader, as opposed to more of this. I don't know about you, but this is not a fun environment to trade, because when this changes course, it's going to be a bigger event, and it's going to be a trend, and a trend that you're either ready for or you're not. So if you've been making money in this environment, scalping the dollar and loving these ranges, good. Congratulations. Because that's what you have to be doing in this environment. But when that environment changes, don't think for a second that your little range strategies are going to do anything, because they're going to suck. I speak highly of that because I experienced it myself in 2014. 2012 and 2013, lightning in a bottle, made a ton of money. 2014, the good thing was I had enough money to recognize I need to scale back my risk, and I don't need to make, crazy trade sizes. But in 2014, the dollar got very strong in a very short amount of time. I got stuck in a positive swap trade, New Zealand dollar long, okay, New Zealand US dollar long, and I got stuck in a trade for about 5 months, stubbornly stayed in it because I was getting positive swap, and I worked through, at that point, was around $100,000 drawdown to get it back to like a $10,000 profit. Okay, if I experienced a flash crash at that time, you wouldn't be talking to me a decade later. Like, that's how over leveraged I was. That's how irresponsible my drawdown was. You know, so you learn from these things. You tighten up your risk. You play defense, and you never let this crap happen again. Okay. Now, to be fair, I mean, it was about a 20% drawdown. Okay. So yeah, was it manageable? Sure. I mean, would I have stayed in if I was at a 70, 80, 90% drawdown? No, no. I'm not that stupid, but it was about a 20% drawdown. 10, 20%. I've handled those drawdowns my whole career in Forex, but also with different allocations. And anyway, that's all. So, all right, that's the dollar. Let's go to some other instruments here. Everyone asks about gold and silver. I'm actually really happy that oil is performing today. I've got some credit spreads on oil at 72.50. My CL is a crude oil futures. I like that it's responding to the upside today. I'm happy with that. Any news that I'm reading here? Top 75 after EIA data. Did that come out today? What's EIA data? Let me see if that's news. So what do we have? Larger than expected drop in U.S. crude. Okay, so I was aware that the U.S. was producing natural gas at all-time highs. I mean, the production levels have been really high for natural gas, which has continued to suppress price there. They fell for the sixth week declining. Okay, so we got this the crude inventories have been falling. So as typical, oil is very much supply and demand heavy. So having less inventory is stabilizing prices a little bit, which I'm pretty happy with. And so CL is looking better for me now. Natty gas. If we come back down to the lows, I'm interested, but I'm not really that interested in natural gas through the winter. I thought this summer natural gas would perform better with people. We had heat waves around the country in the U.S., probably around the world, but like in the U.S., we had some really nasty temperatures and some extreme droughts and heat. And so, getting the ACs up and running, I thought natural gas would be a lot more on the consumption side, but it's still pretty low. Gold, not a lot of movement out of gold today. 23.99. Silver, silver's still one of my favorite trades out there. I'm hoping we can see a nice little push from this past level of resistance right here. I would love to see a move back into this structure, and then a way to add to my winner. So I'm sitting in trades. SLV is where I own the shares of silver. SI, I'm trading futures. Okay, and I have some exposure there. Silver's been a good runner for me this year. I'm hoping for more. I have my SLV shares covered at 35. It's lowered the cost basis into the low 20s. So I own shares around $24, which is okay. But anyway, I'm looking to see if price will respond to something to the upside, and then we'll see if gold and silver are both going to make some fresh runs together. Bitcoin, I'm sure some traders out there were happy to buy the dip around 50K and felt like that was great timing. It could be. But just like with everything else, when we have these kind of flashy moves, look at this on the 1 hour time frame. Here's what I'd like to see. Okay. We have no structure on this decline, and this just dropped like a rock, right? So like I said on the Nikkei and the Japanese yen, this goes down very aggressively, rips up here for a little bit. If this turns over, okay, what I'm going to look for is this. If this turns over south, okay, I'm just going to wait for a trend line break and then look to get long there. Because if I don't get another bullish position and it just keeps going down, I think this low can get retested. I'd rather try to buy it here or wait for confirmation I don't know. I mean, I know right now the mining costs are around 79K. You'd like to think that we're going to catch up. And for everyone that's kicking themselves if I should have bought Bitcoin here and I should have bought Bitcoin here, here's my best thought about Bitcoin. Okay. If you have a risk capital amount you're willing to set aside, that's what Bitcoin goes for. So example, let's say it's me. I'm willing to put $10,000 into Bitcoin. I'm willing to risk that. Okay. I can put $10,000 in right now at $56,000 and say that's it. Bitcoin, my base cost is 56K. If it goes to 100 grand, I'll double my money. If it goes to 200 some thousand, if it goes to $1 million, right? If it goes to $1 million, that's 20x my return. I can take 10 grand and turn it into $200,000. Freaking sweet. Okay. But do I want to deploy $10,000 of risk capital right now at this price? And you're going to kick yourself if we're talking about Bitcoin at 75K and higher and you only put in a couple $1,000s. Okay. You're not going to kick yourself if you put in a little bit now and it dips to 50, you put in a little bit more and it dips to 35 or 30 and you put in a little bit more. But we don't know if that's going to be the case. Retesting 50, retesting 40, retesting 30 might happen, but it might happen if the overall market is also down. So if there's resiliency in the stock market, there's probably resiliency in Bitcoin for right now. Right. So I look at it as it's risk capital, it's dollar cost averaging. I'm pretty bullish on Bitcoin to see whatever I'm willing to risk. $1 million spot price is my target. I know it seems crazy, but it's not. It's really not. Because if we keep having these cycles where Bitcoin is doing its thing and it's surviving and it's still out there, everyone's trying to figure out like it's trading like the Nasdaq. It's not trading like the Nasdaq. It's safe haven. It's better than gold. Nobody knows, right? Nobody knows. So at the end of the day, it's just risk capital. And if you're willing to risk it, you got a 20x biscuit. Okay. For $1 million spot price, that's about 20x return, whatever that number looks like. Get excited about it. There's not a lot of asymmetry in the market that I can think. I mean, that would be the same as saying like, okay, the S&P is going to go to the S&P at 5,000 is going to go to 100,000. Is that going to happen? I don't know. I doubt it. Maybe when we're all dead. But Bitcoin, the way that it's ran from 3 to 20, 3 again to 60 to and then pulled back to 15 and 20, based at 20, ran up to 75. Those type of runs happen. So it's risk capital. I'm bullish until $1 million. I think that makes a lot of sense for me as a trader, but I'm not going to overstep what I'm comfortable risking, because could it go to zero? Just like everything else, it can go to zero. Okay. So it's not a sure thing. Nothing is. That's Bitcoin. But do I like it at 50K? Sure, for a little taste. Do I like it at 40 and 30? A lot more. But I don't know. What I'll be watching is if there's a chance to get in, I might throw a little bit more at it. Right? Right? Long term, yeah, of course, long term. I'm not talking about overnight, obviously. I mean, look, what's the stretch? I mean, the reality of this would be if we rip. I mean, look at this structure though. This structure bullish is actually looks pretty good. You take this low, you take this high. This has been hanging in there with some resilience, right? If you take this low and high, this market is finding some efficiencies right in here. This is a really good buy opportunity. I mean, if we stabilize from here, making our way back to these highs, stabilizing again, if we get to fresh highs, Bitcoin gets a lot more exciting at all-time highs. But as far as investing for that potential run, it's now. But we never know, right? You invest now, it's like, oh my gosh, I got in here and it dropped to 31,000. What a terrible trade. Well, what if 31 goes to 100? Not a terrible trade. You don't know, right? So it's risk capital forever. But it is what it is. Okay. Am I bullish on the yen? No. The yen has had its fun. It screwed up the markets a little bit. And I'm watching to see, day in, day out for this week. I'm liking the fact that the yen is getting weaker. Okay. I like the fact the yen's getting weaker. I do think that there's been some structural damage. Anything else here? I'll talk about Mag 7s and other stuff. We're good on gold, silver, Bitcoin. Yes. I've not paid attention to earnings this week. I'll get to those in a second if anybody's interested. But for JPY crosses, I mean, look, we're getting a bit of a pullback here, right? And it looks very similar to the Nikkei. I mean, just think about the structure, right? We just went from a 2-year, over 2-year. Okay, I just realized this yesterday. I was doing a video on TradingView, and I posted that video. And as I was doing it, I'm like, wait a minute. I said this during my video. I was like, we were in a carry trade since March of 2022. Oh my gosh, it's been over 2 years. I caught myself yesterday, like, oh, you dummy. Like, I was thinking like the inverted yield curve in October. And anyway, March of 2022 is when this carry trade started. The rip that we saw in the Japanese yen, the positive swap the market gave us, this all kicked into 2022, right? Swap for traders kicked into 2023. Okay. So anyway, we've been going for 2+ years in this carry trade, and this now unraveled very quickly. So what I think we're dealing with right now is we have a high, we have a low. Don't be surprised at a 38% or a 50% if this market tries to take a stab back to the downside. This is not a good thing, right? If the JPY gets stronger, this is not a good thing because that's going to make risk appetite feel like crap. That's going to be risk off trading. All right. So could it be sooner than later? Sure. We could have this crazy move. We can come to the 38% and we can retest the lows. Now, we also might do this. We might go sideways on the yen because it just made a big fat crash and we're trying to figure out what's next for the yen. Okay. Look, if you're in the yen, awesome. If you're not in the yen, who cares? But it does matter what this yen wants to do. It does matter what the Nikkei 225 is going to do. You may not want it to, but for the first time in a long time, another index I think has a decent amount of influence on what the US market's going to do. Because right now, there's lots and lots of leverage out there that had Japanese yen exposure, right? Maybe you don't know it, but you borrowed in yen to put it everywhere else. You borrowed yen to pay for US treasuries. You borrowed yen to put it in the US stock market. You borrowed yen to put it in the Nikkei 225 because it's the only thing that's going up. And it just shed 27% from top to bottom in 3 weeks. It's crazy stuff. Okay. So I don't know what the Japanese yen wants to do. But I do know that I'm watching it to see if we're going down, the tone is not going to be great. It's going to be risk off. So as we get here with this little bit of weakness in the yen, I could see a 382, I could see a 50, but based on this structure, this is super, super clean to see this thing head lower, right? High, low structure. We come back up here and we head back down. Could we go lower? Look, this would feel a little bit like 2008. Not going to lie. The Japanese yen made a big fat move in 2008 and it wasn't pretty. And it didn't really pull back. It was more like down, pause, down, pause, down. It was awful. For 7,000 pips, the yens were moving. If we're about to see this all happen again, carry trade's done, Anton. Right? There is no carry trade. If this is unraveling, that carry trade is toast. This is a deleveraging event that we saw happen like in 3 days. It was out there. It was bubbling under the surface. It just became activated very quickly. Right. So do I want this to be 2008 all over again? Of course not. But having the Japanese yen in the mix and having the Nikkei and the leverage, having that in the mix, it does make things a little bit choppier and a little bit dicier. Okay. So just my thoughts. Maybe I'm ranting, but I've done this long enough. I'm just giving a little warning out there. Like it's going to get ugly. If things are falling, man, it's going to be ugly. I wish it was easy, but it's not going to be fun. It's about, digging in and surviving if it gets really nasty out there. So I'm prepared. It's just be prepared with us. That's all I'm saying. Right? So in the near term, if the JPY continues to get weaker and the Nikkei pulls back, that's fine. I'd look for those equilibrium points. If we have a high to low, we pull back equilibrium to 50%. Okay, fine. At the backside of this trend line, if this Japanese yen starts to turn over, there's going to be some short-term opportunities to look for some JPY strength. Now, my style of trading with the Japanese yen right now is if you're taking this to a smaller time frame, if this hits, let's say this starts to turn over around that 50% zone. Well, this starts to roll over, getting a trade in, stop loss above, you get yourself into profit, move that stop loss to break even, and don't even freaking worry about it. Like I want to be precise and aggressive and get that risk-free trade. And if this thing wants to dump, you're in it and you're profiting from it. But I want to take such little risk on the yen. It's so hard to consistently trade the yen with big profits. Okay. These are like once it's almost like the yen has to have like outlier type moves in order to make money, because the rest of it's just like garbage and nothing really happens. But 2022 was the carry trade, and then we had an unraveling in the end of 2022 into 2023. Then the carry trade resumed. We had an unraveling here. So what's next? Is it more carry trade? I doubt it. Is it more financial Armageddon? I doubt it, but I don't know. So I just don't want to be caught on the wrong side of it, and I don't think anybody does. If anybody's been stuck in a Japanese yen trade ever in their career, it's unpleasant, to say the least. So I hope that's not the case. So that's what I'm watching in the Japanese yen. Let's take a look at yields. Okay. We are now, the 2 and the 10 is getting closer. I was all week I was saying about 0.1%. Now it's into 0.7%. The 10 and the 2 years getting closer to getting out of the inversion. Another potential recession indicator is when we come out of those inverted yield curves. That usually has not looked good for stocks. I also want to take a look at the 3 and the 30 year, which also has been at a high level. Let me see something here. If I compare the 3 and the 30, let's go this. Let me go US, the 3-month yield, which has been staying around, we'll say since May of last year, around 5.5%. Okay, and then the US 30 year, which has been dropping. We had a high back in, let me go back to May of 2023. So so about 1.5%. Steepened on the 30 year, came back down. Where are we at right now on the 3-month? 5.2, so we're about 1% off. All right, that's another kind of spread that I'm going to be paying attention to. Rates haven't changed much. 30 year, 15 year, 1 year variable. But anyway, bond market. The bonds have kind of responded with some weakness. So they faded in a big way. They kind of They were front running the rate cut expectations. I mean, bonds have dropped a decent amount. So TLT has gone up from 99 back down to 96. I'm still long on TLT out to 2026, so I'm still trading this a little bit longer term. I'll hang on to that one for a while. Okay. What's the expected monthly percentage return for trading usually? I don't really set that goal. I just trade, man. Honestly, like I've done this for clients for a long time. I've made big chunks of profit in March, big chunks of profit in May, big chunks of profit in August, big chunks of profit in December. It never really matters. What I do is I just trade to the best of my ability and see the P&L for the year. If I have positions that I'm not happy with by the end of the year, I'm not closing out just to get paid by the end of the year. I'll carry positions into the new year. I'm only trading to make the most amount of money that I can with the safest risk. So if it happens to be, steady, 1%, 2%, 3% every month or so, that's fine. That's great. But my favorites are the big injections. I love having a 5% month. I love having an 8% month. Those are my favorites, and that's because I've got positions working and then I've got a nice little kind of crescendo of profits. So when those happen, those are my favorites, but it's never planned. I mean, if I was doing that, then I'd be a day trader. If I'm like, what do I need to make this week? I'd be a day trader. I'm not a day trader. I don't like it. I like watching. I like generating some extra income, but I'm not a day trader. My success has been in the bigger picture. So it's too noisy it's too noisy. Like if I'm a day trader, you'd never have me in these live sessions because it's impossible to do this and day trade. It is. Unless I was like, all right, everybody, how about you guys sit here and watch me for 60 minutes, say absolutely nothing, but just talk out loud about price action. That's what I would do. I wouldn't talk about anything outside of watching one instrument, and I'm watching every tick, and I'm watching this thing for an hour glued to my screen to try to find a trade. And the hardest thing is not trading. Because when you feel like you go to work every day looking for trades, you're probably going to push the button. And I got out of that habit, in 2008, 2009. I did a lot of day trading when I started trading, Forex especially. I'm out of that. Okay. First 2 years, they were okay. I took my first. I mean, I've been trading stocks since 2000. Stocks are easy. I mean, honestly, if you just stay in the market stock wise, it's easy. Just invest. Invest and give it time and stop caring about it. Passive investing is pretty straightforward. Yes, you're going to take some lumps. There's going to be some pullbacks if you care. But this is a blip. I talked to a couple buddies of mine that are financial advisors. I was asking if any clients called in, like paying attention to stuff. And he's like, well, we've kind of, behavioral wise, we kind of condition them to like not really bother us when stuff like this happens because it's not a big event. Like it was a vol event, but it wasn't like, everyone was down a ton because, financial advisors are trading freaking mutual funds. They're not trading options and leverage instruments like futures. They're not hedged. They're not active and, not tactical like I am. So for them, it's probably like, oh yeah, the market dropped 10%. Their portfolio is probably down maybe 7 if they're good financial advisors, or down maybe 12 to 15 if they're bad. But that's reality. It's a little bit above or below the benchmark, and they just kind of hover with the market all the time. But my first 2 years when I started getting serious about trading full time, trading every day, was when I was in Forex. And so my biggest jump was like 2,500 is my first account ever in Forex, 2,500 to 10 grand. That took about a year and a half. I was aggressive. I was trading, standard loss at the time with 101 leverage. I didn't know that was a problem, but it was. I was trading way too big. But I was also in and out with no more than 100 pip or $100, stop losses, like 20 pips, half a standard lot to a standard lot, like $50 to $100 a day. I did that a lot. But then once I scaled back, 10 grand was my plateau. Like it was kind of I was looking at the profit calculators at 10 grand and seeing like, okay, 10 grand could become 20 and 20 to 50 and 50. So I just got ahead of myself as far as what I can earn. And that caused me a little bit of trouble where I'm just like, I started getting greedy and kind of gambling and trading bigger and revenge trading. And so my oscillation at 10 grand took about another, probably 6 to 12 months. And then I just deviated from day trading into like swing trading and more long term. And all of a sudden I went from 10 to 25 and then 25 to 150. That was the biggest jump over like a 2-year window. So I was fortunate that I've never blown up an account. Knock on wood, I hope that never happens, but I think I'm pretty conservative now where it's like, I could take a huge loss and it's probably going to be like 15, 20%, 25%. It'd be pretty ugly, but I think I can still trade my way out of things. Okay. Favorite stop loss. Oh, thanks, World of Sport. That's awfully nice. Favorite trading pair. Aussie CAD, probably one of my favorites. Aussie CAD's one of my favorites for currencies, for sure. Pound dollar, Dev. The dollar, I talked about it. The dollar, I don't love anything with the dollar. The pound dollar is no exception, right? Look at all this noise, right? All the dollar's been doing, the pound dollar especially, just making noise. So it's a big, fat, ugly broadening pattern that keeps coming back to this central point around 2,700, 2,800. I don't know what this thing wants to do. So I'm not trading it. Okay. New Zealand pairs, that's a good question. Shank's asking. So I think all these pairs are pretty interesting. Like the Euro Aussie, it's a top. The hard part is I was looking for resistance. This is a great setup. I didn't have a freaking order there. I was looking for resistance right here to see if the market would turn. Well, it absolutely did, right? It absolutely did turn. The problem was it turned on a freaking dime because it was a flash crash type move. So I was looking to get short Euro Aussie. I was looking to get short Euro New Zealand, and all of them turned. Okay, all of them turned so aggressively that now I'm just kind of waiting it out. So Euro New Zealand could be decent. Meaning, if you dive into a smaller time frame, this could be left shoulder or something like that, like a topping pattern, and then we have a resistance is holding, right? And then we work our way back down to this level down here. So we have, it kind of ran the stops and ran those liquidity levels, and here we are just sitting here waiting to see if this is going to be following through, and we'll see if this goes from resistance all the way back down to support. So I don't mind looking for like Euro New Zealand structurally looks good for a short. The problem is it just moves so fast, so quickly at the highs. I just didn't get a chance to short it. Pound Aussie, Pound New Zealand in a very similar situation. So do I like this one? Sure. I take this down to like a 1-hour chart, look for a bigger swing, something like this, right? So, like here's a trade. I think this is a valid trade. It'd be a swing trade, but you go high to low, okay? High to low. The swing would be, put it at a 50%, and you're going to have risk on here to, if you go 50% or 61%, your call. The high is around that 61%. I have all these numbers for a reason. A 50% is efficiency, 55% is the in between. If you really want that 618 percentage, the golden ratio. 55 is like good enough. Get filled. Because if it misses your bid price or your ask price, you're not going to get filled. So I think 50% is fine. You're looking at a swing stop loss of around 270 to 280 pips, but your profit target is 400 to 600. So your risk reward is very favorable, and you can take the right trade size to risk less than 1%. I think that's a valid swing on the Euro New Zealand. Okay. So I'm looking for an opportunity to be short. I just want to see if we get a swing trade, put on half of 1%. If it goes out, it pays 1.5%. Cool. It's a good trade. Okay. Pound Aussie. Same thing on Pound Aussie. This thing dumped hard. If I look at this as a swing opportunity, okay, high to low. But look, this thing dumped 700 pips in the last couple of weeks. So again, I would set it up with a small percentage risk. We get back into here to that 5-0. We set a stop loss above the swing high, trade small enough. This is less than 1% risk, and then go after a swing there for a 2-to-1 or better. Right? Slightly favorable. The 618 is going to be a little bit lower. So I mean, that's what's nice about defined risk. I like the trade. I like the level. Set the stop loss where it's appropriate, and a swing either works or it doesn't. When you put on a swing trade and it's defined risk at half 1% or quarter 1% or 1%, it's either a winner or it's not. The nice thing is when you win bigger. You win 1.5 times your risk. You win 2 times your risk. You win 3.5. Whatever. If your risk is manageable percentage wise, and your gains are that or better, all you have to do is have a decent win rate. 50+%. You're making money at a 2-to-1. You're actually killing it at 2-to-1. If your win rate's 50%, but you make 2-to-1 on your wins, you're freaking awesome. Okay. So my point is Euro Aussie, Euro New Zealand, Pound Aussie, Pound New Zealand are all in the same boat. I've been looking for tops on these. The Pound New Zealand was a wild, wild move, right? Like this one blew through. This was such a stupid trade, honestly. This thing ran from 207 to 28, almost 219. I mean, that was a 1,200 pip move. And look, I was looking for a short opportunity right here. Okay. And I didn't have confirmation. And now all of a sudden this thing is already back down. Well, fudge, man. Like, how do I get a trade now? I kind of don't. So if we either pull back to this trend line, maybe there's a chance for this thing to still be in an uptrend. Okay. Or I need to let this like volatility settle in and see if we just kind of pull back and then make another attempt to hit these lows and just be more like range trading. It's a little bit ugly because it had such a high spike above these highs that it's an ugly range. So that's all. I mean, if I'm looking at it, like Euro New Zealand looks cleaner. Okay. Pound Aussie's okay. Pound New Zealand's okay. But the Euro Aussie, Euro New Zealand to me are a little bit cleaner. They obeyed structure a little bit better. And so if I'm looking at a swing trade, I like those better. How many pips is your stop? Look at the chart. You can't set a swing stop loss and say my pip size, my pip distance. It's what the chart says. That Euro New Zealand trade was 270 pips. If I did a swing trade on the Pound Aussie or Pound New Zealand, it's probably 300 to 400 pips. That shouldn't scare anybody because trade size is your friend. Trade size at a micro lot, you risk $26 on one, you risk $36 on the other. Okay? If that trade size is too big, then get a web platform that trade nano lots on and risk less. But you can always trade small and accommodate any type of trade you want. You can risk 500 pips, 1,000 pips, and make it manageable with the small trade size. Okay. Where will it pull back to? I just told you on those swings, I'm looking for like that 50% zone, 618 zone. Look at a simple fib. Oops. Hang on a second. If we pull back, and I'll wrap things up here. I've got a session in a few minutes here. And Chandler, thanks for letting me run a little bit longer. So if we have a swing, all I did is put the swing trade up here. Let me go to the 4-hour time frame. Okay. So my pullback zone would be somewhere around this 83.85, and then my stop loss is above this 86.50. So I put a sell in here. I put a stop loss maybe 20 pips above this high, 25 pips above the high, and it hits the swing trade at 50%, drops down to that 2.7 or 6.18, and it's just a swing. I'm also a big fan of symmetry. So if we go from high to low, okay, and we pull back to a 6.18, project that high to low, and that's your profit. That is the easiest trade. That is 15 years of Forex trading in a nutshell. If I can give you a swing trade right there, A to B equals C to D. That's the easiest tip I can ever give you for powerful swing trading. Don't try to trade it to a 618 or extension that's way out here. Trade to symmetry. Easiest trade ever. Because if it works, you get about a 2-to-1 every single time, and it's a high probability move because it's measured every single time. Easy swing trading. Okay. All right. I'm going to let you go. What's the chance it'll pull back? Shanks, you feel like I got a crystal ball, dude. I don't know. The chance it pulls back 50% is probably 50%. You know, I mean, do you believe the market moves in waves and structures and fibs and pullbacks? If you use it, it's probably going to pull back. This left tip over here is back to around the 618. So probability wise, I believe in the Forex market for structure and symmetry and efficiency a lot more than others. So if this is where the left structure is, I could see the right structure doing the same thing right in there. And then we look for a fall. Okay. Other than that, look, who cares? If you take a trade right here as a pending order, what happens? Okay. You get filled, you make money. You get filled, you lose money. You get filled, and then you wait. That's all that happens. So if your risk is manageable, where if this happens, you make money. Awesome. If this happens, you lose money. Who cares? Go find another trade. If you make money here, fine. Expect to take a trade, expect to win. When you don't win, don't cry over it. That's why your trade size is small and the risk is manageable, because you're going to take another trade and you're going to find another winner. There's always another trade, right? There's never a guarantee. It's just a trade. Your career, however long you trade, is going to be defined over years and years and years and years of trading. All right. I can promise you that the GameStop millionaires and the Bitcoin millionaires have probably pissed away a lot of their profits because they had no idea what they were doing. To make money in the long run, it is a process. Okay. I'm going to leave you with that today. All right. Thanks. We'll see you tomorrow.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.